Our Perspective podcast in October 2024, like always with Guy Wagner. Good morning, Guy.
Good morning.
Guy, in several recent Perspective podcasts, we've discussed the situation of the US economy, which was predicted to go into a recession. But it's holding up well. Is this a good sign for you?
It's a good sign, generally speaking, because obviously everybody wants to avoid a US recession. What one has to note is that basically private spending remains quite robust in the US, helped also to a certain degree by public spending. But we all know that the US economy is very much based on on private consumption. So it's important for private consumption to continue to do well, and for the moment that's the case. On the other hand, what's a little bit worrying is that the other sectors and also the other regions are still quite weak. So we still have this basically picture of a US economy, but also a world economy basically still being very dependent on the US consumer.
Mm. The US Federal Reserve's Fed interest rate cut announced in September was expected all over, but its size, 50 basis points, took many observers by surprise. How do you explain this significant move?
I think you can explain it by saying that the Federal Reserve, to a certain degree, changed its priorities in the sense that over the last 2 or 3 years, the main priority was to fight inflation, to get inflation down again. And now it seems that the Fed has switched to another priority, which is to help the labor market. The labor market showed some signs of deterioration a few months ago. And so I suppose that the Federal Reserve wanted to clearly make sure that by cutting interest rates, they would show the market, but also its intention to help support the labor market if there were to be a further deterioration.
Mm-hmm. In Europe, on the other hand, the indicators are still in the red, and the economies of the traditional powerhouses, France and Germany, are sluggish, almost stagnant. Is there a way out of this situation?
Right now, to be frank, it's quite difficult to see how their outlook could improve substantially, at least in the short to medium term. Obviously, if the world economy accelerates, that will also help these two countries. But both of them have structural problems. In Germany, it's a little bit this idea of deindustrialization, linked also to some very bad economic choices. In France, it's the public deficit, and obviously also the lack of political stability, which right now at least worries the market quite a bit. So it's difficult to see both economies now improving substantially in the short to medium term because there are a lot of structural problems. Right now there's a lack of political will to attack these problems in a structural way.
Okay. The European Central Bank, ECB, also cut its key interest rates by 50 basis points between June and September, but it did so in 2 stages. Will this be enough to take the Eurozone's inflation rate permanently below 2%?
Yeah, I think its aim by cutting interest rates was to help the economy. When it comes to inflation, you could say that maybe the cuts were premature because when you look at, and that's also true for the United States, when you look at inflation rates, yes, they've come down, but they're still not really at the 2% objectives that the central banks officially have. And when you look behind the numbers at the core rates of inflation, they're still some 100 basis points above these 2%, say more around 3%. So by cutting interest rates now, you could even say that maybe in the medium term we'll get another inflationary problem.
China is not at its best either and has recently announced a set of monetary and fiscal measures to stimulate economic activity. Do you think these are the right steps, the right message?
It's difficult to say because we don't have all the details when it comes to these measures. The measures are a mixture of monetary measures like cutting interest rates. Then there are measures to support the real estate market, which really is a big problem right now in China. And then you have fiscal measures, but where we don't have all the details. But I think generally speaking, what this has shown is the willingness of the Chinese authorities now to help the economy and to make sure that maybe the growth rate will accelerate again.
Let's go to the financial markets. The financial markets ended the third quarter on a rising note despite fairly high volatility. Which regions are generating the most attractive performance at the moment for you?
When you only look at the third quarter, the best performance was the markets of Asia ex-Japan, helped by what we just said. China's measures have led to a very strong rise in the Chinese equity market, and that obviously has helped the Asian region as a whole. Weakest market was Japan because with the rise in the interest rates of the Bank of Japan and the appreciation of the yen, the market went down quite heavily in the beginning of August. Since then, it has recovered somewhat, but still over the third quarter, it had a negative performance. And Europe and US had a positive performance, US again outperforming Europe, but they have had again a decent performance over the third quarter.
Bottom line will be that Asian markets are still some 10% below their level at the start of 2021, where the global index has doubled in that time. Does this suggest that there will be plenty of room for improvement?
At least it shows that there are quite a bit of arguments in favor of these markets. You could say they're often much cheaper. Earnings growth potential, at least over the next few months, seems to be higher than in other regions. Now also we see easing of monetary policy in the US that should also help this region. So from that point of view, there are arguments to be made for this region. One always has to be aware that when you look at Asia ex-Japan or even emerging markets, the two big markets are China and India. So a lot of depends on these two, and India has performed quite well. And then you also have some stocks which have a very high weighting in these markets, especially in the technology sector. Stocks like Taiwan Semiconductor or Samsung are quite big weightings in this sector. So a lot of the, let's say, performance of the typical indices of these regions depends basically on China, India, and on a few stocks.
Let's go a step deeper. What about the investment sectors? Are the big technology stocks still heading the leaderboard? Could small caps pick up steam?
Yeah, we saw a bit of a rotation in the third quarter. The big technology stocks, which were clearly the main drivers for the stock markets this year again. But in the third quarter, they underperformed a little bit, and there were other sectors which basically performed better, whether it's other sectors or whether it's also smaller companies which did quite well in the third sector. Whether this rotation will last or it was only a temporary rotation will depend to a very large degree on how the economy will evolve.
In your recently published edition of Perspective 181, you note a shift in investor interest from growth stocks with high valuation multiples to stocks that tend to be more neglected. Why is this? It is a question of the entry price?
I suppose it's a question of the entry price, but more fundamentally, I think it reflects the change in the way that markets are looking at the economy. So until not so long ago, clearly markets were more afraid by this risk of a US recession. That's no longer the case. Why? Because we had the monetary easing of the Fed, and as you were saying in the beginning, the Fed cut its interest rates more aggressively than what was generally expected. So that's helpful. And then also with now the measures taken by China to stimulate its economy. So the market's anticipations have changed. So the market is no longer speaking about a possible recession. It's even speaking about a possible reacceleration of growth. And that basically helps a lot of sectors outside the technology sector. And then the other reason, you just mentioned it, is that often these sectors are much cheaper than the big technology names.
Let's talk about the bond market. In the current global context of national budget deficits, the bond market seems to be a collateral victim as investors turn their interest to equities. Do you think this trend will continue? What are the potential routes out of this run?
Yeah, I think you could say that to a certain degree there's a paradigm shift when it comes to the bond markets, in the sense that those segments of the bond markets that were typically looked upon as being safe havens, the government bonds of the G7 countries, have become much more risky because of the very high public debt levels and the increasing budget deficits. So that's a segment, I think, which is really not very attractive going forward, and there might be other segments within the bond markets which are more attractive, whether it's emerging market bonds, whether it's corporate bonds, but obviously one also has to be aware that these segments typically are much more volatile.
Mm. And finally, as usual, let's have a quick word about gold, which is continue its significant rise. Do you see any limit to its progressing, considering it's such a favorable climate for it?
I would say that generally speaking, the environment for gold is still very positive. What one has to be aware of is that the rise in the gold price last year and even during the first half of this year was essentially based on physical demand. There was no financial demand. Financial demand was even negative. So the ETCs, the exchange-traded funds in gold, had a lot of outflows, so they had to sell gold. So from that point of view, the financial demand was negative, but that was more than compensated by the very strong physical demand. And the physical demand is mainly central banks buying gold, and it's mostly central banks from the East. And that has led to the rise in the gold price last year and over the first half of this year. What we are seeing now is that the financial demand is coming back too, because it's linked to interest rates. We see start of the monetary easing in the West. There's again from the more financial demand, financial interest in gold. So financial demand is now coming back. Physical demand is still quite strong. So from that point of view, that's still a very positive environment for gold. Now, this being said, one has to be aware the gold price has gone up a lot in a very short period of time. So there's always a potential that there will be a correction. There's also always a possibility that maybe for 1 quarter, 2 quarters, or even a year, central banks will no longer buy gold. And that obviously would lead to some kind of a correction in the gold price. One has to be aware of that. But fundamentally speaking, when we look at all the secular trends going on in the world economy, that's still a very positive environment for gold.
Mm. Surprisingly, gold mining companies have been slow to benefit from the rising value of gold. How do you explain this lag?
I think the explanation is simply that the rise in the price of gold was physical demand. Central banks buying gold, and central banks are buying gold, they're not buying gold equities. So that meant that there was no real demand for gold equities, and so from that point of view, they didn't really participate in the rising gold price. That has started to change now in the second quarter of this year, because as I said before, financial demand is now coming back, and we see return of financial demand. There's also the return of demand for these gold equities, which explains why over the past few months they have participated in the rising gold price.
Does this mean it's a good time to invest in gold mining companies?
I think it's a very good time to invest in gold mining companies in the sense that we were just saying the gold price has gone up quite a bit. At the same time, their costs, which also tended to go up over the past 2 years with the rising labor costs and energy costs, their costs also are now behaving better. And so from that point of view, their profit margins have increased quite a bit. So it's really an interesting sector from that point of view. But it's always, and one always has to be aware, it's a dangerous sector in the sense that it's a very volatile sector. You have a lot of other risks, geopolitical risks, etc. So you have to be very prudent when investing in this sector.
Guy Wagner, thank you very much for your time.
Thank you.
Take care and see you next time.
Thank you.